When banks fail, who really pays? Hi, everyone, and welcome to Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, Branko is joining us to discuss the further fallout from the failure of Silicon Valley Bank late last week, and where this leaves us going forward in an environment of still stubbornly high inflation, as well as signs that the cure in terms of high interest rates is also responsible for the problem that we're having with these banks failing. So how are you going today, Branko?
Good, thanks, Chris. Thanks for having me back.
So the news today, further sort of talking about what we were discussing on Monday, this bank failure that occurred, and then a subsequent another bank that needed to be closed, and lots of bank stocks were falling in Wall Street over the last few days. There was a bit of a bounce last night, but there's just a lot of uncertainty, a lot of contagion, a lot of risks that are being discussed. So we've talked a little bit about what happened in the Silicon Valley Bank case a little bit, but can you maybe start us off today by telling us why it's a little bit different to traditional banks, and maybe give us a little bit more background about what's happened and what's emerged about what's happened there?
Yep. So obviously we're all aware of what's going on. Silicon Valley Bank, the 15th largest bank in the US, has gone bankrupt. And to kind of give some important background to all of this is that Silicon Valley Bank isn't a traditional bank in terms of they don't really utilize the fractional lending that a CommBank or an ANZ would, because their customer base is mainly tech entrepreneurs, that have a lot of capital and money. They actually have more deposits than loans. So the reason that's important is because they didn't actually get into the situation through risky lending practices, but rather difficulty or was called like a inappropriate diversification of investments. So I think
Sorry, just interrupt there, because that's a really important point that I don't think everyone has understood. That normally you would think, like if you were just looking at it from a layperson's perspective, you'd think if a bank has a lot of deposits, that's a good thing, right? A bank having a lot of loans out there would seem to be the bad thing, because you'd say, well, loans are complicated because you're relying on people to pay them back. There's risks involved if property prices go up and down, all sorts of risks involved. When it's straight deposits in the bank, that should be about as safe as you can get.
And you would think so. And they actually had a very good risk rating. Like they were considered a very safe bank as consequences of that. But, the reason as to why they went bankrupt was because they had all this money. They wanted to provide a good yield for their depositors, and they put more than 50% of their capital into treasury bonds. And the problem with that is, given interest rates have been, going up and up and up the past couple of years, that the valuation on those bonds has dropped so much that it's made them insolvent.
And that's my understanding of that, is because if you had a long bond, so they had to get longer dated bonds. So they had to go out on the curve and get bonds that maybe are 10 years or, that a long time. And when you do that, at the time, they were probably paying good rates for the time, might have been a couple of percent. But as the rates went up, then those bonds decrease in value, because now why would you do that when you can get one for only a couple of years that's paying a higher rate? So no one wants to buy them anymore. That's the actual mechanics of that, isn't it?
Absolutely. It's similar to the RBA earlier in the year when they lost a lot of money on bonds. It was kind of the same thing, where they were holding all these bonds that went down in value because of the interest rate crisis and, consistent increases that were going on. So that is why they're in this situation.
Yep.
And just some important context around why it's different to other, other banks and other potential collapses.
So understanding that, what actually caused the collapse itself? Because from everything you've said so far, it's all relatively safe. Like you shouldn't be waking up to your bank has collapsed in that environment. I wouldn't be thinking.
Yeah, so it was the treasury bonds, like I said earlier, but to add to that, one interesting note to take is that these banks still have a heavy risk appetite. No matter the amount of deposits they have, and they want to get high yields to attract depositors. Yeah. So I guess the key point is, even if a bank's balance sheet might look very good, always look under the hood, and there might be potential warning signs in the future. So I think the key is that even though they are in this good, safe, low risk profile to begin with, given the need to attract depositors, they still, didn't diversify as well as they should have, and that has cost them.
And that to me is quite scary, because the argument is, how do you look beneath the hood? Like, if you're just a depositor, is that even your responsibility ultimately?
Yeah.
Because I know, if I go and bank in a bank in Australia, I kind of work on the assumption that the regulators are looking under the hood, that it's not my job to go and specifically investigate the financials of each of the major banks to make a decision of what bank to bank in. I mean, maybe I'm wrong on that, but I think a lot of people would agree with me.
No, absolutely. I mean, it shouldn't be the consumer's responsibility or the customer's responsibility, but it doesn't necessarily look like the banks and the governments maybe have our best interests in heart in a lot of these areas.
No, and that's always going to be the case where it's driven by profit, of course.
Yeah.
So let's just switch to talking about this bailout, because the title of the news today and the discussions in that piece were really framing this as a bailout. And I know a lot of people don't want to look at it that way. The government doesn't want to look at it that way. But how does this bailout work? How is it structured? Can you just give us sort of that background? Because that's relatively new information that we're starting to pour over now.
So the FDIC in the US insures every bank account for $250,000.
Yep.
And that is the baseline, right? So anything over that theoretically should be lost in SVB if they had money in Silicon Valley Bank. However, what the government is saying now is they're going to insure all depositor money, and they're trying not to frame this as a bailout by saying that the FDIC is going to actually fund that extra amount.
Yep.
But if you just think critically for 1 second, you realize, wait a minute, how are they going to get this money? It doesn't make sense for an entity that doesn't have the capital, because remember, they're supposed to have $250,000 insured for every bank in America.
Yep.
They obviously don't have the capital to fund the full amount at the Silicon Valley Bank, but they're going to do it anyway. So now there are a few avenues that the government can take to potentially fund this bailout, and they are, they could just borrow money, which seems like the way to go for a lot of countries, or they could raise taxes, which would directly impact citizens, or they could increase the money supply, which, as we've seen over the past couple of years, is going to basically present like an inflation tax on people as well. So any way you look at it, the government has to kind of, through the FDIC, sponsor and fund this bailout.
Mm-hmm.
But the US government doesn't really want to call it that, and we'll kind of get into that now. But they have a very differing view.
Yeah, so maybe talk to us about that. What do the government, what are they saying? What is the Fed saying about this? Why? How are they rationalizing that it's not a bailout?
So Janet Yellen, who used to work for the Fed, now is the Treasury Secretary, she's saying that, this isn't 2008. Lots of bad things happened then. We're going to rescue, customer money. It's all about rescuing customer money. But the thing is that, firstly, if you're a regular person, you don't have more than $250,000 in your bank account anyway.
Very important point. Yes.
So the people that it's rescuing is really the elite tech entrepreneurs in the US. Yeah. That's the first point. And again, a bailout is using taxpayer money, so socializing the losses, and effectively, they privatize the games, right? When these tech entrepreneurs make a bunch of money, they don't give back. I mean, they do pay more taxes, but they're not socializing those profits. They're obviously, as they should, have their own profits. But as a consequence of this, they're now in a situation where, because of a poor risk management from their part, right? Like, they could have easily have put, if they had $2 million, they could have easily have put 8 different bank accounts open with $250K each and just left it in there. Because of pure laziness now, they've decided to have it all in one, and that's gone bust. So obviously, I think it's wrong that the people will effectively subsidize this bailout, and the government doesn't want to refer to it as a bailout because, let's be honest, they would lose the kind of PR war.
Yeah.
So they're trying everything they can to kind of compare it to 2008 because it was a bit more greed, in the partners of those banks than that we're seeing now. But at the end of the day, it's the same.
And I think that highlights what my problem is with it. I accept. Well, actually, I kind of agree with you on that argument about the 250,000. And you go, well, if you're dealing with the larger amounts, there were actually mechanisms, from my understanding, in place that, for example, if you were a very large company and needed a larger deposit, you could actually arrange extra insurance and things. There are facilities to do that. So you could argue, like, it's like if you buy a car and you crash the car, well, if you didn't have insurance on the car, well, that's on you. So you could make that argument. And the people with larger balances are not your everyday, person with a bank account. I mean, the average person doesn't have $250,000 in their account. And I know it was over 90% in that particular bank had well over $250,000 in there, because exactly what you said, it wasn't really a normal situation. It was very much a specialized bank lending to people with a lot of money, or startups with a lot of money. But my real issue with it is where this leads us to the future, because it's effectively created a moral hazard here. The government is not coming out and saying we're only insuring these banks. They're being particularly vague and saying really all deposits are safe. So does that pseudo mean, even though they're not saying the words, does that mean that it doesn't really matter which bank fails, they'll come to the rescue of depositors? And if that's the case, that seems to be massively problematic, because what incentive is there then for banks to do the right thing? If you're a small bank and you want to attract more customers, then you can be as risky as you want, and customers will follow you if you're paying higher rates on deposits, for example. They'll come over to you if, I can come to you because I don't bear that risk, because if the bank fails, oh, well, the government will bail me out. Like that seems to be a big problem.
I think that is a great point, Chris. I think the future of kind of banking in America and Australia could change quite a bit if they're implicitly implying that they're going to bail out everyone. We're going to see increased crazy lending practices, risky investing to try and get high investments, because at the end of the day, it's going to become about attracting depositor money more than ever, as opposed to actually being a bit more defensive and just trying to maintain capital. So I think,
and that's the great irony here, isn't it? Because you could argue, I mean, they may have made mistakes and whatever, but you could argue that bank was actually trying to do the right thing, because they were investing in ultra safe government bonds, right? Like they weren't wildly speculating on loans. They were kind of doing the right thing. And now, if you're going to get bailed out, other banks will go, well, didn't work in that situation, let's just do the riskier stuff.
I think we're going to see more in that, and that's going to lead to, potentially a more kind of unstable economy. And I mean, that's a very good point. That's not a very good future outlook for the stability of Western economies if this continues.
Well, Branko, thanks for all of that analysis today. I mean, it's something we obviously need to keep watching, because this may not be the end. Like, it seems to have settled down briefly. One day is not really a trend in terms of, whether it's out of the system yet. But I think that risk is definitely there, that we see more of this, and people will certainly not be overly concerned if they believe that the government is coming to their aid to bail them out every single time something fails. So absolutely. Thank you for keeping your eye on that, and we'll keep watching it for sure.
Thanks, Chris.
All right. Well, thanks everyone else for watching as well. Remember, if you have any questions, reach out on social platforms. That's the best way to get in contact, and we'll respond to those. We'll talk about them on the show. That's us for today. Stay safe in the markets, everyone, as we watch closely to see what unfolds next, because it's certainly exciting. And we'll talk to you again with Alex back on Monday.